Hi, I'm Taylor Kiesig. I'm a partner here at Evershed Sutherland.
Hi, I'm Stephanie Wood, and I'm an associate at Evershed Sutherland.
And today we're going to talk to you about Global Intangible Low-Taxed Income, or GILTI. So what is GILTI? GILTI is a new U.S. international tax provision that was enacted as part of the recent tax bill, and it's effectively a new worldwide minimum tax on the earnings of a U.S. shareholder's controlled foreign corporations, or CFCs. Now, the starting point for GILTI is gross income, but it excludes a permitted return on tangible business assets. In other words, notwithstanding the name, it's not necessarily a tax on the income from intangible assets. The tax bill retains the existing Subpart F regime and layers GILTI on top. And GILTI is similar to, though distinct from, Subpart F income. So how do you calculate GILTI? Now, there's a couple definitions and formulas here, but we're going to run through those and give an example to illustrate. At a high level, what GILTI is determined at the U.S. shareholder level, and it is the net amount of a U.S. shareholder's CFC's tested income or loss. Tested income is the gross income of the CFC reduced by certain amounts, including Subpart F income, as well as deductions that are allocable to that income, including taxes. And to the extent the deductions exceed the income, you'd have tested loss that could be netted at the shareholder level. Now, that is reduced at the shareholder level by net deemed tangible income return, and that's our permitted return on tangible assets referred to earlier. So that's going to be 10% of the asset basis in tangible depreciable property. And as Stephanie's going to tell us, GILTI is just the starting point for figuring out the U.S. tax consequences to the U.S. shareholder.
U.S. corporate shareholders are permitted a 50% deduction with respect to the GILTI inclusion. This deduction is also limited to taxable income in the year of inclusion. Further, U.S. corporate shareholders are permitted a foreign tax credit. However, this foreign tax credit is limited to 80% of the foreign tax credits associated with GILTI. These credits are allocated to a separate basket. Also, this 80% limitation is not used when determining the Section 78 gross up. To illustrate these principles, we're going to go over a simple example. In our example, a U.S. corporation wholly owns a CFC. This CFC has $1,000 of gross income and paid $100 in foreign taxes. This results in $900 of tested income. Also, the CFC has a $2,000 basis in its assets.
So, as we said, the starting point for determining our consequence to the U.S. shareholder is figuring out GILTI. In this case, we started with $1,000 of gross income, and as Stephanie said, we reduced that by our 100 of taxes, resulting in 900 of tested income. And our deemed tangible income return here is going to be $200, or 10% of our 2,000 of asset basis. So that gives us 700 of GILTI in our starting point for determining the consequences.
And to determine the U.S. residual tax for the U.S. corporation, one has to take into consideration the foreign tax credit, the gross up amount, as well as the deduction. When determining the foreign tax credit, the $100 of taxes is reduced by the 80% limitation as well as the income inclusion. However, this 80% limitation is not applied when determining the gross up amount. When determining the deduction, one takes into consideration both the GILTI amount as well as the Section 78 gross up. This results in about $19 of U.S. tax when applying the 21% corporate tax rate.
So we referred to this earlier as a worldwide minimum tax, and the reason is illustrated here. The CFC was subject to local tax at a rate of 10%, and there was a residual U.S. tax liability. The way that these provisions work together, if the local tax exceeds about 13.125%, if the U.S. shareholder is able to claim the full amount of credits, there should be no residual U.S. tax liability. And that's why we refer to it as a minimum tax.
For more information about this topic and similar topics, please visit our website at eversheds-sutherland.com.